and welcome to another episode of Classroom. Today we're discussing the precious commodity space or the bullion space. Often that gets narrowed down to just gold, but there are many other facets to it, and of course precious commodities themselves represent quite an interesting avenue, both in terms of investment and in terms of trading and making some money. Gold, as you know, is your all-weather investment. You can own it in the good times, the bad times, inflation, equity market crash, war, what have you. But here's more about what makes these markets tick and how you can go about investing in them. My guest today, Rajan Venkatesh of Scotia Mukata, Naveen Mathur of Angel Broking, and Anjani Sinha. Naveen, let me start with you and with definitions. How would you define gold as an asset?
See, any asset class which gives you a return is called as an asset. Means any financial value does it carry. It is an asset broadly defined, Mithali. Gold particularly is an asset class which acts as a safe haven. It's a store of value kind of an asset class. So you flock towards gold to have returns. You flock towards gold to act as a portfolio diversifier. You buy gold for your income, for insurance against uncertainties. Rightly said, war, financial markets uncertainty, geopolitical tensions, all that are incidents where people would definitely love to have gold in their portfolio, and that's why it is treated as one of the asset classes in part of the portfolio.
Rajan, the question that comes up for something like gold, though, is pricing. I mean, in 2008, we saw it go to that $1,000 level, and then we've seen it crash, rebound. Would you describe it as an extremely volatile commodity, or is there a discernible trend in the pricing?
Let's just step back and examine what really happened in 2008. In March of 2008, one of the big U.S. equity firms, Bear Stearns, collapsed. And that created a huge amount of panic in the global markets, with the result that people started moving away from equity, from debt markets, etc., into gold. And that was the reason for the upward spiral in the gold prices. Now, again, if you look at July of 2008, Lehman Brothers collapsed, and that created another huge crisis of confidence globally. The immediate impact of that Lehman Brothers collapse was a sell everything and hold cash syndrome. What people wanted, all the banks, the funds, the institutions, everybody had only one motivation in mind, and that was sell everything and hold cash as an asset. Not even stocks, not even bonds, not even gold. That sell-off is what created a tapering of the gold prices later on in 2008. Now, to answer your question on the volatility, yes, gold, like any other currency or commodity, is volatile. But that volatility depends upon macroeconomic factors. Studies indicate that the volatility on gold over the last 20 years has been around 15%, whereas compared to other equity indices, which is hovering around the 25% mark. So, yes, it is volatile, but the volatility is lower compared to other assets.
So, Anjani, how do you weigh out a commodity like gold versus stocks? What has the traditional performance parameter been for gold and for equity markets?
Gold has always been a preferred investment asset for Indian investors. Whenever people feel shaky about the stock market behavior, or they feel shaky about political scenario or any other geopolitical issues, then a lot of investment comes into gold. And particularly in India, traditionally we have seen that so many people keep on investing gold in a usual manner, on a regular basis. The reason being that gold is always considered to be a safe haven asset. It is a hedge against inflation. It is a hedge against any sudden downfall of a stock market, and therefore gold is always a preferred investment asset for all the investors.
Rajan, you want to come in on that?